Since pandemic lows, mid-caps have outperformed large-cap stocks, giving investors bonanza multi-bagger returns, especially over the past 18 months. The Nifty Mid-Cap Index has surged over 52% in 1 year as compared to the Nifty 50's 30% rise. But if mid-caps have been such consistent outperformers, why are experts and analysts trying to signal caution now? Before we get into that, let's take a look at what's driven the rally so far. Strong domestic flows from both institutional investors and retail participants have driven up the stock prices across the broader markets. More than 50% of current investors in domestic mutual funds have put their money in the markets over the past 3 years as more and more retail participants have flooded the equities with their money, looking to maximize their gains and returns. Let's take a look at the change in shareholding patterns over the past 5 years. Since 2019, FIIs have reduced their holdings in Indian markets, especially the Nifty 50 and Mid-Cap Index, by around a whopping 100 basis points. However, where FIIs have sold, DIIs and retail investors have bought. DIIs and retail shareholding has increased over NSE indices by around 400 basis points. Also, there are expectations of higher earnings growth from mid-cap companies. This is causing optimism in the stocks as compared to the Nifty 50 heavyweight, which makes investors more bullish on the mid-cap side. As a result of a combination of these factors, investors have bet heavily on these mid-cap stocks. However, with limited floating equity in the market, mid-cap stock prices have surged way beyond their fundamental values, according to experts. It is really interesting to note that this rally has been mixed. On one hand, new leaders are emerging from investment-related sectors such as industrials, energy, and real estate. While some of these have extremely strong fundamentals, others are based on the ongoing narratives in the market or the hype. On the other hand, old favorites such as building materials, QSRs, and retail are lagging in trade compared to the new gainers. According to a report by Kotak Institutional Equities, apart from the hunt for increased returns and expectations of improved earnings, the Indian markets are also thriving on narratives or general hype. People buy into a story or an idea, moving from narrative to narrative, and this is the key reason and key driver of returns over this period of 18 months. The markets are thriving on narratives, buying into stories. Some of these narratives have been, for example, an increased consumption boost in the budget, increased capex allocation, or the privatization of PSUs. According to Kotak, the market has become immune to increasing disruption risks in just about every sector, and valuations are now sky high. This worry with investing based on narratives or hype is that they have a very short lifespan. Look at some of the mid-cap underperformers that were once D Street's darlings. Their respective narratives have fizzled out and faded, and in turn, their stock price performance shows that. Stocks initially rise because of their strong performance, but often hype drives these prices up too fast as more and more money starts to chase these stocks. But as long as the rally continues, investors are lulled into a sense of belief that they will be able to offload their holdings at the right time. But then again, that's the tricky part, isn't it?